This call is open for investors in Ellerston Asian Investments. If you're a member of the media, you should disconnect now and request a formal interview by contacting us. All information contained herein is confidential and must not be reproduced without the consent of Ellerston Asian Investments. You should also be aware that any information is general and does not take into account your personal objectives, financial situation, or needs. Well, good morning, everyone, and thank you for joining the Ellerston Asian Investments webinar. My name is Lisa Rose, and I'm the Head of Intermediary Sales at Ellerston Capital. This morning's webinar format will be slightly different to previous. As many of you will have seen already, the EAI board made an announcement to the ASX last night to advise of a proposed strategy to address the persistent discount to NTA and to also announce some team changes that have taken place. As such, today we're joined by the Chairman of EAI, Bill Best, along with the newly appointed Portfolio Manager, Freddie Ho, and the broader Asia ex-Japan team, including Eric Fong and Vinay Choda. To start, I'll hand over to Bill to make a brief statement on the announcement, and then Bill will be available online to take any shareholder questions that need to be addressed. If you would like to ask Bill and the team a question throughout the session, you can submit this at any time. Please do so by entering your inquiry into the question section of your webinar panel located on the right-hand side of your screen. I'll now hand over to Bill.
Thanks, Lisa, and good morning, everybody. As Lisa mentioned, we made a release to the exchange last night, which covered off on two items. The first one relates to the departure of Mary Manning to another fund manager, I believe. Mary has been the manager since listing and has built a great team around her. One of those team members is Freddie Ho, who's been with Ellerston Capital since April 2017 in the capacity as Deputy Portfolio Manager. So Freddie is stepping up into the Portfolio Manager role, and you'll hear from Freddie in terms of leading the discussion post my comments. The second area we sought to focus on in our release is the perennial issue for most LICs, and that is the discount to NTA. Over the last financial year, that discount has narrowed for Ellerston Asia. However, it is still at a double-digit number, approximately 11.5% to pre-tax NTA at the moment, and has varied from something like 23% to 6.5% during the course of that period. At the end of the day, that is not a sustainable position, and what the board is saying is that we will continue over the course of this calendar year to seek to narrow that through our dividend policy, through our on-market buyback, albeit that has been relatively quiet over the last 12 months. And further, if we find ourselves in a situation at the end of this year, early next year, where the discount persists, then we will do a thorough analysis of the various options which are open to us, a number of which everyone on this call will be familiar with. Obviously, we went through this situation with Ellerston Global 18 months or so ago. That's not necessarily the path we'll take for Ellerston Asia if we need to, but we just wanted the market to know that we remain very conscious of the issue, and we're not just going to allow things to roll along as is. Having said that, we're confident in Freddie and the team, and confident that they will do an excellent job, and we hope that that will be reflected in, obviously, performance, and following that, a narrowing in the discount. So that's all I had at the moment, but happy to take questions.
Thank you, Bill. At the moment, there's no questions that have come through for you. Bill, okay. If you'd be so kind as to stay on the line with us, perhaps questions may come through as the webinar proceeds and we can ask them of you towards the end.
Excellent. Thank you.
Wonderful. Thank you, Bill. All right, I'm now going to pass to Freddie and the team to provide an update on key macro thematics within the Asian region and how these will impact the portfolio, and provide an update on positioning and performance as at May. Freddie, I'll now pass over to you.
Thanks, Lisa, and good morning, everyone. Firstly, I'd like to clarify that Mary's decision to leave is to pursue a new outside opportunity and not based on any other factors. I'd like to thank Mary for all of her contributions to Ellerston Asia. We can all acknowledge that she's done a lot for this fund over the past few years. So whilst it's sad to see her leave, I wish her the best of luck on her. I'd also like the opportunity at the beginning of this webinar just to touch on a few things that may be on investor minds, particularly around the team and the strategy of the fund going forward. Firstly, on the team structure. As Lisa mentioned, I will take over from Mary as portfolio manager. I have 14 years of finance industry experience, and I've been the deputy portfolio manager for the past 4.5 years, working alongside Mary under her tutelage. I'm excited by the challenge ahead. I'm looking forward to the opportunity to generate returns for investors by focusing on picking good stocks that meet our growth and ESG criteria. In addition to my portfolio management responsibilities, I will also continue to cover the tech sector, and this has historically been an area of significant alpha generation for the fund. So that's something I would like to continue doing. I think it's also important to highlight that the broader Ellerston Asia team remains in place. Eric Fong, our senior analyst, will continue to cover the consumer and China internet names. Vinay Chota will cover India and take on the added responsibilities of the Asian financials until we find a suitable replacement to take on Mary's sector coverage. Vinay currently covers our Indian financials already, so I have confidence that he will be able to pick up the coverage of the other financials in the meantime. I think it's also worth highlighting that the team has been together for a number of years now. Eric and myself have been with Ellerston pretty much since the inception of the fund, and our working relationship extends well beyond our time. Vinay has been with Ellerston for just over 2 years, and he has settled in nicely. But one of the standout features of this fund is that we are all extremely passionate about Asia. We have all lived in Asia at some point in our lives. We all speak Asian languages, and we have all built extensive contacts across Asia over many years. And I think these features are extremely valuable, and we will leverage this knowledge and experience to help maximize the performance of the fund. I'd also like the opportunity to highlight that the broader Ellerston Capital firm has significant intellectual knowledge that the team can draw upon, and that will help in my decision. The second point I'd like to focus on is on process. I'd like to reassure investors that there will be no change to the philosophy, the DNA, and the strategy of the fund. We'll continue to focus on generating alpha for investors by picking the most exciting growth opportunities within Asia that meet our bottom-up, top-down, and ESG criteria. The only thing that may change is the way that we implement and reflect our investment process. But aside from that, everything will remain the same. The portfolio will remain high growth, it will remain high quality, it will be large cap focused, it will remain concentrated, and will continue to have a very strong focus on ESG. Me and the team have already started the process of reviewing the entire portfolio and our focus list in order to determine whether our investment and position sizing are appropriate for the level of conviction we currently have in these names. And I just want to reiterate that we will be disciplined in the way that we invest and the risk that we take. Our number one goal is to improve the performance of the fund. So that's it in terms of an update on our team and strategy. And next, I just want to quickly touch on a couple of things that's impacting Asia currently from a portfolio standpoint. Firstly, on the COVID situation in Asia. As many of you are aware, since our last investor webinar, a number of Asian countries such as India, Malaysia, Taiwan, Thailand, and Vietnam have unfortunately experienced a second wave. India, for instance, saw daily case numbers peak at around 400,000 people per day in early May. Unfortunately, as you can see in the bottom right-hand table, vaccine rollouts for many of these countries have been much slower than the more developed countries. And this has meant that lockdowns has been the only effective way to control the second wave. At present, all of the countries I listed before are still seeing some sort of lockdowns currently. When we saw with the first wave, that lockdowns can be extremely disruptive both economically and to corporate earnings. So because of this, we think that expectations around the pace and the magnitude of the growth recovery for many parts of Asia is no longer as good as it was earlier this year. And this leads us to take a more cautious approach with regards to country selection. And as you'll see in the following slide, some second wave countries such as India are trading at essentially all-time highs in terms of valuation, in terms of levels as well. And they look overbought at a technical level. And given the continued uncertainty around the COVID situation in those countries, this is another reason why we are positioned more cautiously than we have been in the past, particularly in COVID-affected countries. So for instance, we have no exposure in Malaysia, Vietnam, and Thailand, and we've reduced our exposure to India in recent months. So in light of what I just said, how is the portfolio position? So the next 3 slides we just touch on the key themes that's driving our portfolio positioning currently. On the first slide, it talks about the global chip shortage. So the global semiconductor industry has been in a supply shortage situation since late last year. This issue has actually gotten worse over the past 6 months. The shortage was caused by a number of events such as strong demand for consumer tech during COVID. This is relating to the work from home thematic. US sanctions on Chinese tech companies such as SMIC and Huawei, and a quicker than expected demand recovery in a number of applications such as automotive. Our discussions with suppliers and third-party consultants in recent months suggest that the chip shortage situation is not likely to be resolved until 2022. So what this means is that manufacturers of these chips are expected to enjoy high capacity utilization and good pricing power well into next year. And we currently have exposure to this thematic through our investments in TSMC, Samsung, and SK Hynix. The second thematic that's driving our portfolio positioning is decarbonisation, and specifically China net zero, which is China's plan to become carbon neutral by 2060. So if you work backwards from there, that means China will need to have peak emissions by 2030, which actually isn't all that far away. We've done a lot of work over the past few months looking at how China is going to change its energy mix in order to reach its peak emissions target and the likely beneficiaries of this. So we've essentially come up with 4 buckets. In the first bucket, you have your renewable energy companies. So these are your solar and wind farm companies. In the second bucket, you've got electric vehicles. In the third bucket, you've got your electric vehicle supply chain. So this includes your infrastructure, so charging station names, your battery makers, and your battery material names as well. And in the fourth bucket, we've got the other green energy alternatives. We concluded in our research that currently the most attractive opportunities exist in the first 2 buckets, so the middle 2 buckets, sorry. The EV space, so the EV vehicles and the EV supply chain, it's very similar to the smartphone industry, where you have established names and a deep supply chain to support it. So we currently have a number of EV-related names in our portfolio, such as NIO, which is essentially the Tesla of China, and then we also own CATL and LG Chem, which are the 2 largest EV battery makers. The third thematic that's driving our portfolio positioning is the potential for rising inflation and a normalization of monetary policy. Most of our listeners would be aware that the US has printed 2 of the highest CPI numbers in over a decade in the past 2 months, and well above the Fed's 2% target. Much of this is a low base effect from last year, and the Fed has been consistent in writing these numbers off as transitory. But when you see, supply-demand imbalances in segments such as semiconductor and the lumber industry as well, and then rising commodity prices and also anecdotes of labor shortages in the US in areas such as construction, that there is a risk that the recent increase in inflation may prove to be more long-lasting than the Fed believes. I think it's a little too early to tell whether the recent inflation pickup is transitory or structural, and we're not going to be able to predict exactly when inflation will cause the Fed to change its mind and tighten monetary policy. But what we can do is start preparing for that scenario. And as you can see in the charts on this slide, rising inflation expectations and not necessarily rising rates have historically been supportive of Asia and Asian financials in particular. So this explains why We have investments in US rate-sensitive companies such as DBS, OCBC, and Hang Seng Bank. And the final slide is on the IPO pipeline in Asia. I mean, notwithstanding the Ant Financial IPO debacle last year, which was a political and regulatory issue than a lack of market appetite for IPOs. You can see on this slide, Asia, and in particular China and India, house some of the biggest unicorns in the world. A number of these unicorns could IPO in the next 1 to 3 years, and these are IPOs that we would be extremely interested in. Didi Chuxing would be first cab off the rank, and Eric's been doing a lot of work on that. We're currently in the PDIE stage of the IPO process, and that's something we would be very interested in participating in. We've participated in 4 IPOs in the past 6 months, and on average, we've generated returns of around 110% on those 4 investments. So we do see IPOs as a positive source of alpha generation. So the next section of the presentation is on positioning. Hong Kong, China is the largest part of our portfolio at just under 50%. India is a much smaller weight than we have had in the past, as the COVID situation over there has gotten worse since our last quarterly update. Yet valuations are trading at all-time highs. So the disconnect over there between reality and financial markets has led us to be more cautious on our India position. Our positioning in Taiwan and Korea has remained steady, as we believe the recent COVID outbreak there is well contained. And in terms of sectors, financials, tech, and consumer remains our 3 core sectors. At a stock level, the stack companies, so TSMC, Tencent, Alibaba, and Samsung remain our largest holdings. And as we highlighted earlier, we've increased our exposure to financials. So you'll see in the top 10 holdings list, we have a couple of Singaporean financials, we have a couple of China financials, we also have Shinhan Financials Bank in Korea. Now turning over to performance, we were up in absolute terms last month, up significantly over the past year. There's been quite a bit of volatility over the past couple of months as the market has lacked a clear direction, and there's been a lack of liquidity over the past few weeks as well. In my mind, that actually presents opportunities for active fund managers like ourselves. And our goal over the next few months is to improve the performance of the fund on an absolute level and also our relative performance as well. And the final slide is on our dividend policy. We've paid 10 cents of dividends over the past 3 years, and we will continue to pay dividends into the future. We know that dividends are important to our investors and shareholders, but there will be no change to our sustainable dividend policy. Our dividend profit reserve currently stands at 15.4 cents. That's essentially equivalent to 3 full years of dividends. So we're comfortable that our dividend profit reserve level is going to allow us to comfortably maintain our sustainable dividend policy. I will also be disciplined in taking profits when appropriate in order to maintain our dividend profit reserve. And that's the end of our formal presentation. I'll turn it back to Lisa to open the lines for Q&A.
Thank you, Freddie. We've had a couple of questions that have come through, a couple for Freddie and one for Bill. Freddie, I'll start with you. Are there any IPOs that the team have not participated in?
Yes, we have turned down at least a dozen IPOs that have come online in the last 6 months. The way we think about IPOs is we put the same amount of work into the IPO companies as we do with our portfolio names, and particularly the portfolio names that enter our, particularly the companies that enter our portfolio. So, the team, Eric, Vinay, and myself, have done a significant amount of work on all of the IPO names, most of the IPO names that have come online in the last 6 months, and we've turned down at least a dozen of them. And by and large, most of the ones we've turned down has proved to be the right decision. And the ones that we have participated in, as I mentioned before, has generated positive alpha for the portfolio.
Brilliant. Thank you, Freddie. Bill, a question that's come through on structure. What impact, if any, has Wilson Asset Management's WAR strategy had on recent initiatives regarding discount to net tangible assets, the EAI?
Can you hear me, Lisa?
We can, Bill. Thank you.
Okay, great. we actually discussed war at our most recent board meeting, and noted that of the various funds which were highlighted in their presentation, we weren't one. Having said that, I think what war tells us is that the industry won't tolerate large discounts on an ongoing basis, and therefore, even though we're not necessarily in their sights, like everyone else, you need to work towards trying to eliminate stroke reduce that, or if you can't through normal approaches, then you have to make some changes. So look, war hasn't specifically had any influence on our thinking, but it's part of a sort of macro movement, if you like, that every board in this space has to be aware of.
Thank you, Bill. That's great. We've got another question for Freddie and the team that's come through. Can you please comment on the severe drought in Taiwan and its impact on production of chips?
Okay, that's a very informed question. I'll cover the tech sector, and Taiwan's very much a tech-focused country, so I'll take that one. So water levels across many parts of Taiwan were running at below 10% at the start of May, so at pretty much critical levels. But my understanding is that since that time, over the past 2 weeks, there's been a significant amount of rainfall that's landed in Taiwan. And my understanding is dam levels are now at around 20%, which is still low, but no longer at that critical level we saw early May. May to September, I think it should be noted that it's typically the wettest months in Taiwan. So there is hope that a normal monsoon season will help ease the drought situation. And in terms of company exposure and production of chips, we've spoken to TSMC about this issue. And so far, they have not been impacted by the water issue at all. In fact, TSMC recycles more water per year than they actually consume. And my understanding is that the company also has access to tankers for purified water if and when they actually need it for emergency reasons. So at this stage, we're comfortable that the drought situation hasn't had an impact on the chip production in Taiwan.
Thank you, Freddie. Next question that's come through. Alibaba is a strong part of your portfolio. Are you concerned about the Chinese government attitude to the company?
Yeah, thanks for the question. Eric covers the China internet name, so if he has anything to add, he can to jump in. Certainly, I mean, the biggest headwind for the share prices of not just Alibaba, but for all of the kind of internet names like Tencent and Baidu and Meituan, for instance, over the past 6 months has been regulation. We believe the regulatory issues, though, are largely behind us. There may be some small incremental announcements, but I think most of the heavy regulatory announcements have already occurred. And we believe part of the reasons why there is increased regulatory scrutiny over the past 6 months, not just for Chinese stocks, but Chinese internet stocks, but for other sectors such as childhood education and property, is the 100-year celebration of the Chinese Communist Party, which is set to take part on July 1st. So the government has essentially been cleaning up house, so to speak, heading into that event. And this is very similar to the regulatory environment that we saw back in 2018 with the PRC 70th anniversary. The regulators back then kind of cracked down on the gaming childhood education names, and that proved to be a very good buying opportunity in the likes of like Tencent. We believe this is similar to 2018. All three of the BAT stocks, including Alibaba, I think are trading at attractive levels. And I think with the regulatory kind of headwinds largely behind us, I think we are currently overweight Alibaba, and that's the reason for that. Eric, is there anything that you would like to add as well?
I thought Freddie covers it really well. And one thing I do want to add is that like Alibaba has been a big part of our portfolio, but if you may recall, back in December, during the December webinar, we have also outlined that, like, due to the ongoing regulatory concerns, we have also trimmed our positions in these China internet names, and that has proven to be the right move. And I think, regulatory risks would always be, a factor when investing in China. So that's something that we'll be watching very closely. But it does seem that the worst in terms of the regulatory risk is behind us, and a lot of these China internet stocks are trading on a very attractive valuation. But yeah, it is a fair question.
Thank you, team. Lots of questions coming through. Next one for you. How can you invest in Korean securities if no one in the team speaks Korean?
Thanks for the question, and that is a good point. No one in the team does speak Korean. But when I picked up coverage of the Korean names 4.5 years ago, what I was immediately surprised by was how capable Korean companies were in terms of their language skills. You can very effectively get by in the corporate world speaking to the corporates in Korea in English. So that the language issue hasn't really been an impediment to how we view Korea and how we invest in Korea. And over the past year, Korea has actually been the countries that have actually helped in terms of that alpha. So that's not something that has been something that's held us back over the past few years.
Thanks, team. Next question for you. Can you give us an outlook for the next 3 to 6 months?
Yeah, I think, thanks for that. Thanks for the question. I think the way to answer this question is to just turn back to, I guess, how we, to our discussion around the thematics that's affecting our portfolio positioning. I think those three factors, this chip supply shortage, and less so the decarbonization, because I think that's a structural thing, but most certainly the potential for more persistent inflation and the kind of persistent potential for rate normalization. I think those are the kind of two high-level aspects that we're focusing on in our portfolio. And as you can see in our portfolio positioning, we've positioned that way. We're overweight the tech hardware names, and we're overweight the financials as well.
Great. Tim, can you talk about the implications to supply chains with TSMC building a facility in Arizona?
Okay, that's a very informed question. TSMC building a fab in Arizona, I think, has more to do with appeasing kind of political concerns that the US have with regards to chip manufacturing in their own backyard. As most of our listeners are aware, Taiwan has a lion's share of the global chip manufacturing market share. They're around 60% market share in total, and most of that is accounted for by TSMC. So I've no doubt in my mind that the decision by TSMC to invest in Arizona and to build in the US has come from the pressure from their US customers. And it also helps that under the Biden administration, it seems most likely that the TSMC fab in Arizona will be subsidized in some part by the US government, and that most certainly will help de-risk the project and also helps with returns for the overall company.
Thank you, Freddie. Question that's come through: how will the strategy or investment process change with your new appointment as portfolio manager?
Thanks for the question. As I was saying earlier, there will be no change. The philosophy, the DNA, and the strategy of the overall fund. I mean, our focus, this is a growth fund, so we're still going to be focused on investing in high growth companies. We have preference for quality. We will try to remain to be, we'll still have a strong focus on ESG, and what we'll be working on over the next few months is our level of concentration with regards to the positions that we have in the portfolio. And that may be the only thing that changes. I also like to reiterate that the change in the PM had nothing to do with the performance. Mary is leaving for no other reasons except to pursue a new outside opportunity, and it had nothing to do with what has happened with Ellerston internally. But getting back to the original question, there will be no change to the strategy. There will be only a change in the way that we implement and reflect our investment process.
Thank you, Freddie. Lots of questions. Another one for you. What impact is expected with the ongoing geopolitical tensions in the Asia-Pacific region, especially with the Belt and Road Initiative?
Thanks for that question. Something that let me just have a think about this question. It's a bit more detailed. Yeah, I think in terms of geopolitics within the region, I think the major flashpoint at this point in time, and it's one that's been highly publicized in the Australian media, is China and Taiwan. From where we stand currently, what we'll say fundamentally is that we believe there will be no armed conflict between China and Taiwan, and that's because of the economic ramifications if China were to strike Taiwan. And it's also, I think, it would be an about face to China's overall strategy. Its focus on soft diplomacy over the past few years, and that's as the question kind of alluded to, that was highlighted by the One Belt One Road initiative, rather than kind of exert influence through armed conflict. The One Belt One Road initiative was trying to exert influence through financial assistance to a number of developing nations. And I think, if there is a flashpoint, a military flashpoint between China and Taiwan, that would be very inconsistent with how China has behaved over the past few years.
Perfect. Thank you, Freddie. Next question. Your cash level looks to have remained steady. What would see you deploy or build up that position?
Thanks for the question. It's true. Our cash level has remained quite steady over the past couple of quarters. The way I see our cash level, it mostly reflects the amount of risk we perceive in the market. And our recently high cash levels have been more reflective of concerns in certain markets, such as India in particular, over the second wave outbreak over there, and also because valuation in that market looks expensive. We are aware that as an active fund manager, we aren't paid to hold cash. So if and when we see an attractive opportunity, we will look to deploy that cash immediately.
Wonderful. Well, that is a whole lot of questions that have come through. We have answered all of them. If investors do have additionals, please do still send them through and we can answer them offline for you. So Freddie, Bill and team, we're going to leave things there for today. To all our participants, we trust you found the session useful. A recording will be sent through to all of you shortly. Our next investment update will take place at the annual general meeting, which is due to take place after financial year end. Once details are finalised, we'll be sure to share date and times with you. If there's anything further needed post-session, please don't hesitate to contact a member of the Ellerston distribution team directly, as we're more than happy to help with any matters as required. Thank you all again for attending, and I trust you have a good rest of your day.